Adrian tells me that maybe 70% of you speak English. For the 30% that don't, here's my apology. This is the only AI in my presentation today, and it's not a good representation of myself. Maybe by next year I will have learned a little bit more Spanish. It's the irony of spending 9 years learning French and German only to be the president of a company developing gold mines in Mexico and having learned zero Spanish is not lost on me. I will be making some other forward-looking statements today. Little warning, if anyone is a Barrick shareholder, Barrick Gold shareholder, they should probably look away from the next 2 slides. Normally we have about 10 minutes to give presentations. I have this extra bit of time, so I thought I'd use it to talk about a few things. Our industry, the gold industry, does a lot of things well, and it does far more things badly, I believe. Minera, for me, is a platform to try to amplify the good that the gold industry can do for shareholders, for communities, and the like. But there's been tremendous value destruction in the industry as well. And we're talking about value investing today, but unfortunately the mining industry, the gold mining industry, has destroyed a lot of value. Here's a Barrick chart versus gold over the last 30 years. When I was a mining analyst in the mid-90s, Barrick had a $45 share price and a $15 billion market cap and a $400 gold price environment. And we've seen a 5-fold increase in gold during this period, and Barrick's stock has fallen 40%. Value creation through dilution, yes, their market cap's up 320% during that period. Their shares outstanding is up 370% during the same period. From an equity shareholder perspective, that is no way to make a return on your investment. So in many ways, I think the largest gold companies now had their heyday 20 years ago when they were growth and value stocks. They're dinosaurs in many ways right now. Their growth is fueled by M&A, which comes with dilution, and dilution is not the friend of anyone in this room. There are good examples. Alamos Gold is a fantastic example. I'm particularly like this. My colleague Victoria Vargas worked with Alamos Gold in the early days, way before this chart started. Alamos Gold, like so many gold producers of today, started off as a small company. This demonstrates with proper execution, with a proper attentiveness to one's shareholders, that you can outperform the gold price. The Barricks and the Newmonts, if you're thinking about, as generalists, investing to take advantage of the gold price, honestly, you're probably better owning gold as your inflationary and portfolio insurance. But there are great examples. Alamos Gold's performance in the last 5 years is remarkable against the overall gold equity tape. Minera, definitely done better than Barrick. We saw post-COVID, my Spanish was just about good enough listening to hear about Adrian talking about 1 year of good performance in our sector. And that's kind of the problem with the gold sector. It's seen as cyclical. I think we can break the cycle of this cyclical nature. But there was a very talky May through September of 2020 where lots of companies had very similar charts to Minera's. And I've also seen kind of a death by 1,000 cuts over the last 3 years as the gold tape has contracted. But I still believe that we represent an opportunity to be at the early stages of like an Alamos Gold or a Wesdome, that are just in their infancy really as gold producers relative to the big peers. Part of this, it's amazing when you align with your shareholders correctly, something our industry doesn't do very well, how concerned you are about dilution. Because you're not just, if you're aligned properly, you're diluting yourself, and there's no value in that. So I'm proud to say that I've invested close to $3 million of my own money at a cost base that's right around where the stock is right now in this company, because I believe in the team, I believe in the business model, and I believe there's an opportunity for a gold company to follow in the footsteps of the Alamos Golds of the world. So very proud of this, also proud of the degree of dilution that we've faced. Now, this is just a snapshot of companies between $50 and $500 million and the degree of dilution that they've suffered over the last 5 or 6 years. Minera's 35% is probably even more impressive in that the bulk of those companies that have diluted considerably more, and there are plenty more that have diluted more than 100% during this time, they haven't built one gold mine, developing a second one. I don't think they're anywhere close to it as advanced as us, but we've still been able to minimize that dilution. And it's a very important metric, whether you're looking at Minera today or any company. How are you as a shareholder going to get diluted down? How's your stake? Are you going to end up in a situation where you own a company that's worth a lot more, but it's issued so much capital that you don't feel the love, so to speak? The great thing about Great Bear that I was very lucky to be a part of was we had a discovery in 2018 that was kind of trapped in a mid-90s share structure. In the 1990s, when I was an analyst, all companies had 10, 15, 20 million shares out. Now they're starting to look like Australian juniors with hundreds and hundreds of millions of shares out at the expiration stage of their company's business. That doesn't allow you to have the torque that we saw with Great Bear that went from 15 cents to a takeout by Kinross at $30 a share. That is why you're investing in the space at the exploration side of it. If you're on the production side, it's more about applying execution to add value through generating a lot of cash flow. And the interesting thing about Minera, at its current stage, I'll get to it actually, I'll leave that one. I got an interesting tidbit from some recent production numbers from Newmont. So I'm not just going to pick on Barrick today, I'll pick on Newmont too. So now I'll go into my regular slide after that little bit of an opening about our gold sector. So Minera has operated in Mexico, or our team has, for 14 years. The elephant in the room, I'll cover right from the start. There's a lot of mixed messages and bad reporting covering open pit mining bans in Mexico, and AMLO, comes up with some crazy stuff pretty much every week that creates consternation amongst people. There are open pit mines in Mexico now. There will be open pit mines 10 and 20 years from now. This is a country built off mining, very historic mining community there, mining history that goes back 500 years. And whatever AMLO likes to say, we will see probably next month the Supreme Court in Mexico overturn a lot of his proposed reforms from last year. And that will be a very important step, because I think it's important to highlight that there is a rule of law in Mexico, even if the current president wants to act above that law. So we've operated there for 14 years. The team built a company called Castle Gold in 2008, built a producer that was sold to Argonaut Gold. The same team still together. We like the north of the country. It's a better part of Mexico. Personally, I'm not going to expose shareholders to a part of the world that I'm not prepared to go to myself. And I'm not prepared to go to large parts of southern Mexico. So I don't think shareholders should be exposed to a place that I'm not prepared to put my feet on the soil. We have one mine in operation, a second mine going through permitting right now, and a third mine that's actually already permitted and waiting in the wings. So we're very good at permitting. We've permitted mines both with the AMLO government and the previous administrations. We have no reason to think our second plan mine won't join the ranks of permitted operations we've done in Mexico. So our projects are pretty advanced. Santana in production, Cerro de Oro, which is a game changer for the company. We hope to have permits before the elections. If they don't come before, it should be shortly thereafter. And La Fortuna, already permitted, but we want to make it bigger before we build it. We want to build it the right way. So we're not the exploration side of the kind of classic Lassonde curve. I love exploration. I just hate the cost of it. That cost is often met with big dilution of shareholders. I hate that as a big shareholder myself. Instead, I'd rather fund that exploration out of the cash flow from operations. So all our operations can start relatively small by industry standards, and then can grow out of that cash flow to be bigger. And what it means is we build mines. Cesar mentioned capital intensity with copper earlier, and he's got very enviable numbers against the industry, and we do too on the gold side. So our builds are incredibly cheap by industry standards. The resource bases are sufficient for that start of mine life, and then a vision to use that cash flow from these operations where we're generating real cash, not cash that's used to service debt repayment for years and years and years. It's cash to go back into the ground to grow these resources, and as the resources grow, we can grow the production profile without curtailing mine life. They also have enviable operating costs. A lot of the all-in sustaining costs in the gold sector, especially in tier 1 jurisdictions like Canada, Australia, the US, is going to be very sticky because of employment and labor costs. So those aren't coming down anytime soon. In Mexico, with an abundance of local talent, local mining contractors, we can produce gold for incredibly high margin. And I think this industry over the years lost sight of the most important metric, which was the bottom line. There was a period where everyone was about how many ounces they had in their resource bases and what their production profile was, but often it came at the expense of profitability. So an enviable operating cost together with industry-leading capital intensity. And I used to say, is it industry-leading? And then I did the data, and yes, it's industry-leading. So if all goes well, the plan is to build this initial 150,000 ounce a year production profile over the next 3 or 4 years. Santana, if it's only ever a 20,000 ounce a year operation, it costs us $10 million to build, and it will spit out over $10 million in free cash a year. So it's a nice little ATM. Started small so that we could take debt on to build our second project, Cerro de Oro. In its basic case, it's a 60,000 ounce a year operation. We see an upside case where it can be closer to 90,000 ounces a year. And that little anecdote I mentioned earlier where I said I was going to pick on Newmont too, that 80,000 ounce profile in 2025, as long as we get the permits for Cerro de Oro sometime this year, should spit off somewhere in the tune of $40 million US in free cash. And to put it in perspective, Newmont last year produced 80 million US of free cash flow from 4 million ounces of production. For 1/50th of that production profile, we can do at least 50% of their free cash flow. And for a growth story like ours, that's tremendous capital to reinvest in the business and grow these assets and assets beyond it. You know, we're in that sweet spot of the growth cycle where I think we can be a growth and value stock rolled into one. And then La Fortuna, that's its base case. We want to make it bigger. It's why it's sat there, you know, with its permits already in hand, because we think it can be a much bigger operation than the base case 50,000 ounces a year. Secret to our success, low capital intensity. You know, with these low capex projects, these sub $30 million kind of capex numbers, it allows us to build these things far cheaper than anyone else in the sector. That means we're not taking on huge amounts of debt that has to be repaid. It means we are far more insulated than a lot of companies have found themselves to be in the last few years, with big inflationary costs in CapEx, which is often being met by big dilutive equity raises to bridge that funding gap. It's a technical team, as I think you'd want with a building gold mines. They've been together largely for the last 13, 14 years when we've needed to bring in talent as we've grown, and we will continue to grow and continue to bring in talent. We've brought in people like Chris Sharp over from Centerra Gold that sees the same, coming from a much bigger company to one like us. He sees the potential in this business model. About 120 million market cap, finished last year with about 13 million in cash. We have a funding package of $25 million lined up for our next mine, so there's not going to be any nasty surprises when we get permits for Cerro de Oro and how are we going to fund it. That money's in place to be drawn down upon receipt of those permits. Our biggest shareholders are actually generalist funds, which I prefer. Resource specialist funds can be quite almost bipolar of how they approach their investments. And these generalists have been with us for 5 or 6 years now. As I said, I own just about 2% of the company, bought in the market alongside our shareholders. I believe appropriate alignment is important. Quickly through the projects, Santana is small. We got it into production. We're actually just about to build it, and then COVID came along, and I've always said, why let a good pandemic get in the way of building a gold mine? So we built it on budget, in the middle of a pandemic, for 10 million Canadian. Started up gold production. 2022 was a good year, and then we were hit by a major regional drought that was going for several years in northern Mexico, Southern California. So we made a conscious business decision to slow down production. So 2023 was almost a write-off year from a production, but it was more important for us to protect the balance sheet than maybe push production levels at a time where water requirements weren't cooperative. A lot of that now has resolved itself. We are waiting on a permit amendment that will allow us to expand operations, but we put out news about a month ago talking about how we were going to up production this year regardless of waiting on that. That's our $10 million mine. Direct cash costs of under $1,000 US in its first major year of production, and those are kind of the ongoing costs we expect. So $2,000 gold is a very, very healthy gold price. What it has exposed is there are a lot of very unhealthy gold producers out there. We love this gold price. We'll gladly take higher levels, and we're positioned very nicely to take advantage of those. But this is actually a very healthy gold price. Maiden resource, it's a few 100,000 ounces to start. That's all we really needed to start. We'll grow it out of cash flow rather than equity raises. Cerro de Oro, though, is a game changer. Up in northern Zacatecas, north of Penasquito, Orla's Camino Rojo, picked it up for about $7 or $8 an ounce in 2020. We got surface rights in place ahead of our permits applications in 2022. We came out with an economic study in 2022, and permit applications were submitted last year. The PEA, well, there's the initial mine life. Again, sub-1,000 AISC. It's an incredibly low strip. It's a low-grade deposit, but it has a remarkably low strip ratio to it. It's a giant earth-moving exercise. So I've had people say, oh, they're more interested in high grade. And I say, high grade, low grade, it's not what you should focus on. It's all about the margin and making money. So it's a $28 million CapEx. Those were the numbers we run at. $1,600 gold. It has 111% IRR, pays back in less than a year, and there's an upside case beyond it. It starts off with about 800,000 ounces. We see about 1.5 million ounce potential here. We're going to grow that out of cash flow. There's a funding package in place. For people that don't like royalties, we got a buyback on that royalty. So it's a $25 million debt and royalty package. No surprises for our shareholders when we get the permitting. The money can be drawn down. We can build it in about 6 months. La Fortuna's waiting in the wings. I'll jump quickly to the PEA. Again, we did this at $1,250 gold. I think it's important projects can work in the lowest gold price environment as well as take advantage of the highest. It's got a 5-year life. We want to make that bigger before we build it. We know there's upside to the deposit. Has remarkable economics. Again, will be a huge cash generator for us, which is going to allow us to build off this platform. And finally, just 2 slides before Adrian yanks me like a poor stand-up comic off the stage. We're also going to do something on the copper side. We think that copper CapEx doesn't have to start with a B. There's a lot of low-grade oxide gold deposits in Mexico that can be approached with $30, $40 million CapEx rather than the hundreds of millions of dollars you see in a lot of developers. So it's a hidden asset within Minera, sits in a sub. At some point, we're going to look to monetize this for our shareholders. We've always had a good job of surfacing value where it's kind of hidden in the company. This is one more example of it. To kind of jump on the copper bandwagon, but hopefully we'll spin out Minera Copper in due course and doing copper what I think we do very well in the gold space. So a few catalysts for the year, but more than that, thank you for attending. It's so nice to see such a large audience wanting to look for value and growth in this market. So thank you.